Because we are all technical traders, we know that in order for us to have the best success, the best probabilities of success, we need the overall environment, or in our terms, the context needs to be in our favor. Now, this is a little different because we are looking at bearish context, but nonetheless, we do want to create and have an environment that is in our favor. And like anything, the more things that we can get in our favor, the better we can feel going into trades. This video we're going to cover everything about what you want in the environment for trampoline trading and what's going to give us the best probabilities and such for success. But first, before we do anything else, we're going to talk about what we do not want. Then we will talk about what our preferable environment is, some share structure basics. Don't shriek back. I know, being technical players, we don't care about fundamental stuff, but I promise it'll be very basic and very straight to the point. We're going to talk about some numbers that we care about. What do the numbers mean? Why are they good? How do we find these numbers? And then just end with the footprints of pain. So let's dig right in. I really felt it was important to put this slide in because if there's one thing I see just all over the place in terms of chat rooms or message boards, headlines, blogs, just anything, is this concept here of, really trying to have to nail things, be a sniper, pinpoint accuracy, and all that sort of stuff. But let's keep in mind and keep at the forefront of our minds, and really this is the cornerstone and the nucleus of trampoline trading, is we're traders looking to make money. I know that sounds very obvious and straightforward, but again, going back and when you look at things and just kind of look at the the overall thoughts towards certain trades, we are not traders looking for an adrenaline rush. So again, we are traders looking to make money. Trampoline trading is about making money. It's not about trying to find an adrenaline rush. If you want an adrenaline rush, I have a great strategy for you. It's called go buy a skydiving ticket, or maybe go deep sea cave diving, where the caves are all around you and you run out of oxygen. I mean, if you want an adrenaline rush, go do one of those things. But what we are not doing, and what trampoline trading does not revolve around, is trying to catch the falling knife. Yes, it's adrenaline producing, exciting time, and if you can nail it exactly, it can be pretty profitable. However, catching a falling knife is not a viable long-term strategy. Why? Because that the trend is totally against you. It's a massive bearish environment. So at the end of the day, the way I look at it is you're just simply gambling. And gambling, again, is not going to be a long-term formula for success. If you want to do that, just head on to Vegas. They'll be happy to take your money, and they'll be happy to just, let the odds be totally in their favor, betting against the house, going against the trend. And you can head out there if you're looking for to gamble, or maybe here's an idea I just came up with this. You can go to Vegas to skydive and gamble. That way you can kill two birds with one stone. Look at that. But to bring this back into the fold of what we've been talking about, in other words, we are looking to trade, or excuse me, we are not looking to trade during the building phase. It'll be more of a transition phase thing, but we'll get to that later. So again, we are not looking to buy during the building phase. That's when the knife is falling, and sure, you can catch a knife every now and then, but when you extrapolate that over the long term, it's just too difficult. The environment is just a gambler's environment, and that's not what the strategy is about. So you're probably sitting there thinking, okay, we get it. We don't want to catch falling knife. So therefore, what the environment, what kind of context do we want? Well, let's just go over some obvious. We want an environment where the odds are tilted in our favor for an upwards move. We want, again, bringing this back into the trampoline trading and what we've talked about, we are ideally looking for signs of transition. So we're looking for that transition phase. We want an environment where, although bearish, is soaked with gasoline and just waiting for a match to be lit and dropped. And we'll get more into that, but if you remember from the previous video, hopefully you can kind of see what I mean by that analogy. But that's the type of environment we want. Bearish, yes, but that's why we're taking precaution. But we want it to really have some good upwards potential. So just some nice gasoline, and we just need that match to be lit and dropped. And while not 100% necessary, knowing short traders are involved is a setup and a great way to tilt things in our strategy. So it's not like we're looking to nail some massive short squeeze every time, but knowing shorts are involved, and as we'll see in this video, knowing that they're involved in a pretty heavy way is a nice way nice kind of little method to tilt things a little bit more. Sure, it takes a little bit of fundamental research and keyword being a little bit, but for what you gain, I think it's well worth it. Okay, everybody go grab a bullet, maybe grab a piece of wood, just grab something you can bite down on as we go through this fundamental stuff. I know we're all technical traders, and this stuff, we're supposed to not care about, but just plow through the video with me, and hopefully I make sense and you see why it's worthwhile. But let's just go over some basic stuff here, the meat and potatoes of fundamentals really as a whole, which all revolves all around the share structure. So let's start off with just the authorized shares. If you know what this means, just, like I said, plow ahead with me here. So authorized shares are just the maximum number of shares that a company could issue, keyword being could. Second is outstanding shares, the number of shares that have been issued by the company. So authorized is the potential, but the outstanding is more of reality. That's kind of how I look at it, is authorized is potential, outstanding equals reality. And the outstanding shares, some of them can be restricted shares, which are not tradable, and those are included in the outstanding. So company issues shares, not all of them are going to be available to trade, so there's going to be some that can the public can get their hands on, others are going to be for management, all that sort of stuff. Now the float, and this is the key one, the float is just the number of shares publicly owned and tradable. So what's the math on that? We take the number of outstanding shares and we minus away the restricted shares, and that gives us the quote unquote the float. So that's just kind of the trader lingo for it. But all that means is what shares are out there in the public that are, you see flashing back and forth when you're looking at level 2. Now that we have those broad overarching share structure terms out of the way, let's get a little bit more nitty gritty. And these are pretty interesting, and just personally, when I first got started, I had no idea that these numbers existed, and I find it almost shocking that they exist because you can get so much from them. So these are the trampoline trading numbers that, again, is going to put the environment and let us know what the environment is. So the first is just the short interest, and short interest means the number of shares that traders and investors have shorted. So again, how many shorts have been or how many shares have been shorted? That's what the short interest is. A lot of times you'll see it defined or put as the short interest percentage, and that is just simply the number of shares short divided by the outstanding shares. So going back to outstanding, remember what that is, and the math is right there. So just an example real quick, let's say there's 50,000 shares shorted and a company has 250,000 shares outstanding. Well, the short interest percent would be 50,000 divided by 250,000, and there you go, 20%. So you would then say the short interest of this company is 20%. Another important number for the trampoline trading is the short interest ratio, and this is just, can you guess it, a ratio of the short interest divided by the average daily volume. This is what you normally would see it called as, and this is what I'm going to refer to it as the days to cover. So the way you calculate this is, again, going with that example, there's 50,000 shares shorted, and the average daily volume, so there's the new variable up here. It was outstanding shares, that was the variable. The one number that has changed now is average daily volume. So 50,000 shares traded, average daily volume of 10,000. Run the math there real quick, and that gives you 5. But the 5 is the days to cover. Remember, that's average daily volume. So if a stock is sitting there and it would take 5 days to cover, then that is going to be a key little clue for us. So again, you have these PowerPoints, so if you need to mull over that math a little bit more, go for it. But we're here to trade, not run a math session. Now the short percent of float is going to be another key statistic that we're going to need to keep track of, and this is the number of shares that traders and investors have shorted compared to the float of a stock. I probably should have underlined that in the slide. So again, the number of shares that traders and investors have shorted compared to the float of the stock. So this is simply taking the number of shares short and you divide that by the float. Remember what the float is, so the float of the stock. So to put some numbers to this, there's 50,000 shares shorted and the company has 175,000 shares in the float. That would mean that 28.6% of the shares or of the float is shorted. So we'll get more into that. But this brings everything together now to the trampoline combo that I like to call it within the strategy. And the trampoline combo is taking these two terms, the days to cover and the short percentage of float. And our baseline metric, our kind of foundational metric, is we want to see at least 5 days to cover and at least 20% of the float shorted. Now, does it need to be like this every time? I'm not going to say that because everybody has their own personal preferences, and if you want to tweak things a little bit, and that can be either direction. You can either raise this number, lower it, same one to that. I'm not going to sit here and dictate you what it has to be, because in all honesty, there is no golden goose, there is no holy grail. There's not a number out there that's going to lead you to success every single time. So these numbers are flexible, but just as a guideline and a baseline, look for environments where it would take the shorts 5 days to cover based on that average volume, and then you want a short percentage of at least 20%. So this slide is meant to kind of put that nail in the coffin of you understanding the environment, the context that we're looking for. So the trampoline combo, remember what we're looking for. We want that bearish environment where it's soaked with gasoline and just waiting for a match to be lit and dropped. So let's think about those two numbers we're looking at. It means that for every 5 shares in the float, one has been shorted. So that's where the 20% comes from. Think about that. Every 5 shares that you see being traded, one of those has been traded, or one of those has been shorted. And believe it or not, there's some stocks where it's as high as 40%. So every out of 5 shares you see traded, 2 of them have been shorted. And that may not seem like a lot, but just think about that. And then we want 5 days where it would take them to cover their short as a whole. Not one individual trader, but all the shorts as an entirety. It would take them 5 days. So think about that. If for some reason people needed to start to buy back their shares to return them, but based on what the daily volume is, it would take 5 days. There's going to be some upwards price movement in that. So that's why I want to see if for whatever reason, whatever the circumstances, we want that to happen where for some reason, the shorts are squeezed. And remember, squeeze implies that they need to buy back those shares, because if a bunch of people need to do something, but there's only so much volume that can cover the average daily volume, then that's where we want to see that days to cover really becomes as a whole. So believe it or not, and as we'll see in examples, 5 is pretty low. I've seen 10 days, 15 days. Think about 15 days. That's 3 weeks based on the average daily volume where it would take to cover for the shorters as a whole to cover their position. 3 weeks. So hopefully you can see the drift here. But this is what we want. We want to know these sorts of numbers because it leads us to these sorts of environments where all it takes is that little spark, and it's a very combustible location, very combustible environment to be in. So where do we find these numbers? Well, first off, I'm not gonna go to these sites right now. In a video down the road when you're watching it, that'll go over the building the watch list and all that stuff. That's when I'll actually go to the stock and I'll walk you through how I do it. But for the time being, and just so you have the sites to go to, I kind of break it into two. The find sites are where you can find stocks that they say, and I'm paranoid, so really, in all actuality, these sites confirmation aren't probably needed, but I don't know. I like to always double check things, especially when the double checking takes, I don't know, 5-10 seconds. So the find sites where you can find ideas on where these environments are sitting are going to be right here at highshortinterest.com and then finviz.com. Again, we'll actually go to these sites in later videos. But what I like to do is after I find the stocks, I like to bring them over to one of these two stocks, or one of these two sites, and just type that in and double check, make sure that the numbers are aligning, and that way I can just kind of have peace of mind. But again, if you're not ultra paranoid like I am and kind of anal retentive about things, then you probably don't need to do that. But nonetheless, wanted to throw it out there. And then who knows when you're going to be watching this video, but from now until then, hopefully it's 15 years down the road since I've done this, who knows what sites are going to be out there. So use the search engines, use those. Here's just a couple of terms I'd recommend, but the more creative you can get, the better. But just short interest data or short stock data, put those in the search engines and see what pops up. I'm not going to sit here and be ignorant or arrogant enough to claim that these are the sites you have to use and that these are the best ones out there. Maybe there's something out there that I don't even know about right now, or maybe there's something that doesn't exist right now. But always remember to use those search engines every now and then. Run some of these searches and see what's out there. And if you find something that's even better than these sites, then more power to you. Then just to conclude and wrap things up, hopefully you're not sitting there, but if you're sitting there fuming saying, hey, this isn't charting, what is all this fundamental stuff? Since when do we want to look at share structure and all this data and do this math, blah, blah, blah? If you're sitting there thinking that, hey, I'm a technical trader, not a fundamental trader, well, let's just get something off. Trampoline trading will still work, and none of this is required. I'll say that again. None of this is required if you find it a waste of time. Trampoline trading will still work. However, don't forget, we are doing everything in our favor, or in our power, to put the odds of success in our favor. So we're trying to tilt any kind of leverage, any kind of inside track we can get in our favor. That's why this stuff is so important. Is it required? No. But is it going to give trampoline trading the best success of working? Yes. And just remember all this, and I know I've gone over this, but I want to end on this. Picture this, these steps that we're talking about right now as just showing some footprints in the sand that are leading to some potential pain. But remember, this pain is not for us. It's actually a profitable opportunity for us, and it's not that hard to find. As we go through and I show you how I build my watch list, you'll see that sure, it does take time, and sure, it's not as quick as just looking at the chart, but I think for the time that you spend versus the potential rewards and potential amount you can tilt things in your favor, I think it's well worth it. So again, don't crucify me here. I know this is a little bit of fundamental stuff, but when it all comes together, as we'll see, hopefully I can persuade you to at least give this a try. But again, if you don't want to do any of this fundamental stuff and just want to look at charts and all that, it would still work, but I just want to make sure we cover all our bases and get as many odds in our favor as possible.